Hey everyone, hope you're having a great Saturday. Welcome to the last part of our webinar series on raising your first round of investments with Surge and Startup India. If you haven't seen our previous sessions, do check them out on our YouTube channel as well. Uh, all these sessions we discuss a lot about first round of investment. How do you go about preparing your company? How do you go about pitching your idea? And once you're through all these processes, and once you get the chance to actually, get into negotiations, how do you make sure that you have the perfect term sheet? How do you make sure that all the legal and financial aspects of the contract are taken care of? So, when you're taking this journey for the first time, there's a whole bunch of questions. And our experts from Sequoia Search team today will guide us through this difficult terrain to get it right the first time. That being said, I'd love to pass this on to Mr. Rajan Anandan, our moderator for the day, who will be taking us through this. Rajan.
Great, thank you, Gautam. Hi, everyone. It's Saturday and it's 4 p.m. India Standard Time, and for the fourth week in a row, we are delighted to be bringing you this webinar series. It's a four-part webinar series. I know that quite a number of you have actually come to part one, part two, and part three. So first and foremost, thank you for joining us. And this is our fourth and final part of our webinar series focused on raising your seed round. So we've had, I think, over the course of the first three webinars, we've had several thousand early stage founders join us to understand various aspects of raising your seed round. So as this is the fourth and final part of it, and I'm delighted to have two of our senior leaders at Sequoia Capital in India here to share their perspectives on two very, very important topics. So what we'll cover in our final series here is term sheet, and specifically, what you should be looking for in the term sheet, what's normal, maybe what could be not normal in a term sheet, and also due diligence. What we find is, especially with seed stage companies, and sometimes even for Series A and B companies, the companies aren't ready with all the material that a new investor would be looking for when due diligence comes around, right? So once you've time to sign your term sheet, you go into due diligence, and because of that, sometimes you can actually get into a very long delay in due diligence. And what we thought it's very important to do as part of this seminar webinar series is share with all of you what investors actually do during due diligence, what do they look for, and that way you can be much better prepared before you actually get to your term sheet, right? And that'll make your investment process go much smoother. And then we're also going to cover both Ashwini and Sandeep are going to cover several other topics that come up, hot issues or topics, and we're hoping that'll be helpful. So that's the focus of what we're going to have today. Let me, as I've done in the past three webinars, just take a couple of minutes to recap for all of you what we're doing here and why we're doing it, and then we'll hand it over to Ashwini and Sandeep. So if you go to the next slide. So as all of you know, this is a very exciting initiative that is a partnership between Startup India, which is Startup India, as all of you know, is part of Invest India, and Surge. As all of you know, Startup India was launched in 2016 by our Honorable Prime Minister Narendra Modi with the objective of turbocharging India's startup ecosystem. And now that we're about 5 years in to the creation of Startup India, I must say, I think as an ecosystem, we're incredibly excited and grateful for what the Startup India team has done. It's actually a very large team. Gautam, who just kicked off the session, is a key member of Startup India. What the Startup India team and this initiative has done under the able leadership of Honorable Prime Minister, and they've ranged all the way from key policies that help the creation and acceleration of startups to lots of enabling aspects. So today, India has a large number of incubators and accelerators that are funded by the government of India. There are lots of capability building programs. I think those of you that dial into various initiatives that Startup India does, I think know of the amazing content and programming and expertise that they bring to you, as well as some very large-scale initiatives. For instance, I'm sure some of you know that India launched a 10,000 crore fund of funds, which is now being deployed through Sydney, which is meant to actually, help create Indian local venture capital funds, where SIDBI, using this 10,000 crore fund of funds, actually anchors new and existing Indian venture capital funds. In fact, before I joined Sequoia, I was on the SIDBI investment external investment advisory committee for several years. So I think all of you know Startup India, but I wanted to again thank, I think, on behalf of the ecosystem, the Startup India team for the great work that we do. And Surge is Sequoia's seed stage program that we launched about 16 months ago, and is very focused on helping seed stage founders accelerate their company building journeys. We basically partner with 15 to 20 companies per cohort. We have two cohorts a year. So in fact, as we speak, we are in our third cohort where we have 15 companies from India and Southeast Asia. And what we really do with these companies is, we structured this to help address the biggest constraints that Sequoia, given our long history, we've been in India for 15 years. We've been, investing globally, especially in the US, for 48 years now. And we launched this because there were several constraints we wanted to address in the early stage startup ecosystem in both India and Southeast Asia. First was the availability of capital. So what we do is, as soon as we partner with a company, we invest $1 to $2 million per company before you start the program. The second was, despite all the progress that we've made in the ecosystem in India, it's still very difficult to get the kind of hands-on support and advice that you need to build an enduring company. So we've structured sort of a 14-week program that's a very intensive program to help seed stage founders with all aspects of building an enduring company, right? Starting with what's your mission? Are you focusing on the right markets? All the way through how do you find product market fit? How do you build product teams? How do you build engineering teams? How do you think about growth, and how do you really make growth happen in a capital efficient way? All the way through, how do you actually structure a board? How do you actually raise your next round of financing, and so on? So that's sort of the second thing we did. Third thing is we provide a lot of very hands-on support in critical areas such as hiring, such as partnerships, such as building sales teams, and so on and so forth, sales teams, engineering teams. And finally, we have a large group of mentors, because we felt that, again, it was very difficult for seed stage founders to get access to high quality mentors. So we've assembled a very large pool of high quality mentors who work with our companies. And then lastly, Surge is an open architecture program. We co-invest with lots of other investors, seed funds, venture funds, angel investors, angel networks. We made it open architecture. So 80% of companies that come into Surge actually have a co-investor. And at the end of Surge, what we do is we have something called Upsurge, where we get 35 to 40 of the top Series A investors who come and have one-on-one meetings with each of our companies. Each company gets to meet one-on-one about 10 or 15 companies. And what we try to do the course of that is help accelerate the process of fundraising, right? So that really is what Surge is. And Surge today is only really focused on, call it 30 to 40 companies a year between India and Southeast Asia. But as we were doing this, what we felt it was important to do is actually help build a lot more awareness, knowledge, and capability in the broader ecosystem, because India today has the third largest ecosystem in the world. Southeast Asia has got a very vibrant ecosystem. And that's why we actually partnered with Startup India to bring you this series on raising your seed round. So with that, now let's get into the 4-part series. If you go to the next slide. So the first 3 parts of our series really were, the first one was around the basics, right? When should you raise your seed round? What are the things that you need to do before your pitch, right? When do you raise your seed round? Who should you reach out to? Who are the type of investors you should look for? We spend a lot of time talking about what do investors want, and so on. So that was the first part of our series. By the way, if you are a seed stage founder, and if you haven't been to our part 1, part 2, and part 3 series, we'd really encourage you to spend some time going through those, because we do think we've gotten terrific feedback from everybody who sort of watched them, attended them, etc. So that was before the pitch. Part 2 of our webinar series was the actual pitch, how to craft your perfect pitch, how to deliver it. Everything from what should you include in a pitch to what are the most important parts of the story that you're trying to tell, as well as some very practical do's and don'ts of pitching. And again, this was part 2 was delivered by Peter Kemps, who's one of our senior leaders, investors on the Surge team. And again, it was received very well. And then last week, we actually had stories from the trenches, where we had 2 other practitioners in addition to myself, Alok Mittal, who's the co-founder of Indify Technologies, but is also one of the founders of Indian Angel Network. He's a very active angel investor. And before he started Indify, was actually leading one of India's top venture capital firms. So we had Alok, and also Shanti Mohan, who's the founder of Let's Venture, which is India's largest, in fact, it's Asia's largest curated marketplace for startups and early stage startups and early stage investors, and where we got lots of very, very practical tips on what are investors currently looking for, what's happening in the COVID environment, who's investing, who's not, as well as views from them on what are active investors, angel investors, seed funds, etc., looking for. And again, that was a very, very insightful and engaging discussion. So let's now move to this fourth webinar series. So if you go to the next slide, so this is part four, and as I said, it's our final fourth part of our four-part series is around really what happens after the pitch, right? So let's say you've been successful, you've got one or more investors who've become very interested in the company that you're trying to build, and then you've got your term sheet. That's really what happens, right? And what we wanted to do today is actually get pretty granular with all of you around what to look for in a seed term sheet, right? By the way, term sheets vary, whether you're a seed stage, Series A, B, C, D. They get more complicated and more detailed, as every subsequent round of financing comes by. But we wanted to go through and have our experts share with you what you should be looking for in a seed term sheet. And what I'd encourage all of you to do is ask a lot of questions, whether you're going through a current funding round or whether you plan to go through a seed funding round. You're going to have a lot of questions, so please ask them. The second thing we wanted to try to cover today is the legal and financial terms and conditions that each of you should be deeply aware of, right? Look, there are many conditions you should expect. So sometimes we find that, founders spend a lot of unnecessary time worrying about certain set of terms and clauses, right? We wanted to sort of let you know what are the things you shouldn't worry about, but we also wanted to highlight some of the things that you should worry about. And then lastly, but most importantly, Sandeep is going to cover how you should prepare for due diligence, right? Especially now that we are basically in an era of social distancing, right? Everything that is happening through Zoom. So, for instance, as I said at Surge, we are in our third cohort where we have 15 companies, but we've already started selecting companies for our fourth cohort, which starts in November, and we have selected 7 companies, right? Almost all those companies we've actually selected essentially like this through Zoom. So, but we do due diligence, and we wanted to share with you what are the things that you should be doing to prepare for due diligence. So with that, before I hand it over to Ashwini, I wanted to introduce my two colleagues. Again, I wanted to thank Sandeep and Ashwini for being here. Both Sandeep and Ashwini are senior leaders of Sequoia, so they work with us on the search team, but they also are responsible broadly, for broader set of responsibilities all across Sequoia, both in India and Southeast Asia. Sandeep Kher is the director and head of portfolio finance at Sequoia Capital India, and Sandeep works with our founders at all stages, right? Seed, Series A, B, C, D, to help them make sure that their financials are in shape, to make sure that they're implementing best practices around financial controls, that they have the scalable set of processes for their businesses to scale, that they have business plans in place, and also helps them actually raise alternate sources of financing when they're needed, and most importantly, also helps them with compliance. So Sandeep actually has a very, very deep view on the kinds of things that seed stage companies simply do not have when they get to the term sheet and due diligence stage, and because of that, there are long delays that happen, right? And I thought, we thought it's very important for Sandeep to come and share with you all the experience that he had. Now, prior to being at Sequoia, Sandeep was the chief risk officer at Max Life Insurance and was also a VP at SBI Card. So he comes to us with lots and lots of experience. I can't imagine anybody better to actually help all of you understand what you should expect in the due diligence process. Because, by the way, Sandeep's team, together with Ashwini and others, actually helps us with due diligence. And then we also have Ashwini Varma. Ashwini is a vice president in our legal team at Sequoia India. Ashwini has been in the legal profession for more than 11 years and has worked with many different law firms and is currently a senior leader in Sequoia's legal team. And Ashwini actually is been spending a lot of time across sectors, across various stages of investment, creating the right legal systems, and support systems for our companies, and is the person at least at Sequoia who's most knowledgeable about term sheets and shareholder agreements. So he works with all his team. Him and his team work with all our founders on legal and compliance related issues. So I wanted to thank Sandeep and Ashwini ahead of time. I hope that you'll all agree with me when we finish this, that this is that they're both extraordinary leaders who will be able to give you a lot of insight. So with that, I'm going to now hand it over to Ashwini to walk us through the first part, which is the term sheet discussion. So with that, Ashwini, over to you.
Thank you very much, Rajan, for the introduction, and very warm welcome to all our viewers and listeners today in our part four of our series on raising your seed fund. As Rajan mentioned, today we will primarily focus on tackling your seed term sheet related queries and diligence related queries. Uh, as far as the moment you have finalized interest from any potential investor for your company, the first document that you're going to receive from their side is a term sheet. As far as approach or practices in relation to term sheet are concerned, different investors follow different approach, different format. But one thing is for sure, there are few terms which you are definitely going to find in every term sheet, irrespective of the stage of the company or the investor who is interested in investing in the company. First and foremost is the valuation of the investee company. You would have all seen or you would have all heard a lot about investors talking about pre-money valuation, post-money valuation. But just to simply put, pre-money valuation for your entity would be the valuation which the investors are willing to give prior to their investment in the company. And mathematically simplified, your pre-money valuation plus the investment amount which the company would be receiving from the incoming investor becomes your post-money valuation. And why it is important for you to understand these concepts is to evaluate the dilution that is actually going to happen in your shareholding. So first and foremost, and the most important thing for any founder would be very clearly understanding the pre-money valuation and the post-money valuation. The second bit which we would like to highlight in terms of importance in a term sheet would be the nature of securities. There are primarily two kind of securities, at least in India: equity shares and preference shares. Now, most of the founders, or rather, I would say all the founders, would be holding equity shares which they would have subscribed to at the time of incorporation of their respective companies. Uh, but the investors always prefer to subscribe to preference shares. And why we call these securities preference shares is because they have preference in terms of payment of dividend or repayment if at all the company is liquidated at a future stage. In both these situations, the investors prefer to have some priority over the equity shareholders for the payout of their investment amount, and that's why their preference has always been customarily to go for to subscribe to preference shares. You would have a lot of time heard about CCPS because in instead of equity shares, preference shares, investors talking about CCPS. CCPS is nothing but a compulsorily convertible preference share. Now, why we say compulsorily convertible is compulsorily convertible preference share is because under Indian legal requirements, a preference share cannot be held forever, and there are certain timelines within which these shares are to be compulsorily converted to equity shares. That's why these are called compulsorily convertible preference shares. Third thing, which as a founder, you should be discussing with investors, plus getting their expert views around setting up your employee stock option plan. Why this is once again very important for founders is this will also result in some dilution for founders as well as the existing shareholders before the investment is made by the investor. ESOPs are generally included in the pre-closing cap table, or as I said, pre-money valuation of the company, and thus may have some impact on the existing shareholders' shareholding in the company. Generally, for early stage companies, we have seen ESOP pool being in the range of 5 to 10%, but there are no hard and fast rules, and it entirely depends on the extent requirements of the company, what are their recruitment plans, and to what extent they want to offer additional shares to their senior management. Moving on, the fourth important bucket for a term sheet would be the economic and governance rights. Economic rights are primarily your liquidation preference, anti-dilution, exit-related rights, which are obviously directly attached to the economic interests of the investors. We'll discuss these rights in detail in the following slides. The second bucket is of governance rights, which is about the board seat, board representation from the investor, observer seats, affirmative voting rights, or as they are famously called, reserved matter rights, then inspection and information rights, which give a lot more visibility to the right holder. The last point which I would like to highlight in relation to the term sheet would be the exclusivity. Exclusivity time period is generally, an indirect restriction on the company not to engage with other prospective investors during certain time period. The reason for existence of this clause is the amount of efforts and the resources which are being invested by any prospective investor to evaluate the company at the due diligence stage. And generally, we have seen this to be in the range of 45 to 60 days for early stage companies. But depending upon the sector and the criticality of the business operations, these can also extend to a longer duration of, say, 90 days or 100 days as well. Then double clicking on the economic rights, the first one and the most important one is liquidation preference. What liquidation preference right does is it lays out the order of distribution of liquidation proceeds if at all the company is liquidated in future. Now, most of the investors prefer that their investment amount is repaid first, or I would rather say not just the investors, but the preference shareholders prefer that at least their investment amount is repaid first, and then the remaining proceeds can be distributed amongst the equity shareholders. This is something very much aligned with the market practice, but there are multiple ways in which this right can be structured, which may or may not work in favor of the founders or other classes of other class shareholders. So some of the examples which we have laid down here, the first one is a preference multiple. Some of the investors or the way they structure the liquidation preference right is if the company ever is liquidated or if there is any liquidity event in relation to the company, the investors should be entitled to certain multiple of the amount that they have invested. This was used used a lot few years back, but gradually the market has already shifted to a 1x non-participating liquidation preference, which we'll elaborate in a few minutes. The second one is participating liquidation preference. The mechanics of participating liquidation preference entitle the right holder to first get their investment amount back and then participate with other classes of shareholders on pro rata basis. This is also famously called a double dip liquidation preference right. Now, the third one, and which is most commonly used and which is something we have seen across the geographies, is 1x non-participating liquidation preference. 1x non-participating liquidation preference side entitles the right holder to get an amount which is higher of either their investment amount or their pro rata entitlement on the basis of their shareholding in the company. This is something which is considered as the most reasonable, or I would say equity shareholder friendly or founder friendly liquidation preference right, and very well accepted in the market. Moving on, another key economic right which you are likely to see in any term sheet is anti-dilution. As the name suggests, it helps the right holder to avoid any unreasonable dilution if the company raises a future round at a lower valuation. There are multiple ways in which this can be affected. The first one is full ratchet. Full ratchet anti-dilution protection entitles the right holder to downward adjust the conversion price of the preference shares that they are holding to match the price of the securities which are issued in a down round. Just to give you an example, if investor A participated or invested in the company at $10 million valuation, resulting in a per share price of 1,000 rupees, and if they are entitled to a full ratchet anti-dilution right, and the company raises company raises the next round at say $7.5 million valuation with a per share price of 750 rupees, the full ratchet anti-dilution right holder will have the right to adjust the conversion price of the preference securities which were issued in the previous round to match the per share price of the securities which are being issued now at 750 rupees, which will result in the shareholding of this right holder going up, and resultantly the founder and the equity shareholders may get diluted. The second and the most commonly used, or I would say most well accepted or well received anti-dilution protection mechanism is a weighted average, broad-based weighted average anti-dilution mechanism. This is considered much better for founders and equity shareholders for the reason that it also takes into consideration the total number of shares the company is proposing to issue as well as the amount it is going to raise. It takes these factors into consideration, resulting in much lower dilution for the equity shareholders and the founders. Last one, and something which is rarely used is milestone based, because at the time of the investment there are a lot of projections made to the incoming investors, or some future events are already taken into consideration in valuation, and therefore the conversion price of the preference shares is connected with such future events. So for example, if company achieving certain EBITDA, or company getting a certain number of consumers, customers, will result in finalizing the conversion price of the preference share being issued in that particular round. The third one is the third economic right which we would like to discuss today is exit rights. Uh, as you may all be aware, most of the funds which invest, or most of the institutional investors who invest in companies, they invest through fund structures, and all the funds have limited life cycle, and the fund managers are obligated to return the funds to the limited partners after expiry of certain time period. That's why don't be surprised if even in a very early stage or term sheet, investors ask you to set out certain exit timelines. This obviously varies on the basis of the sectors or the stage of the company, but on an average, we have seen this to be in the range of 5 to 7 years. And some of the most commonly used exit rights we have seen are IPO, which is the listing of the company on stock exchanges, then trade sale, which is also referred to strategic sale sometimes, which would result in more or less the sale of the entire company to a prospective buyer, or at least transfer of such number of shares, which would result in change of control at the company level. Then there is third-party sale, where the company facilitates transfer of shares held by the respective investor. Then there is buyback, which entitled the investor to request the company for buyback of their shares, depending upon obviously the regulatory restrictions and the cash available with the company, which can be utilized for buyback. Uh, the last, exit right, which we have seen most commonly, especially if we see this waterfall, would be a drag sale right. So if the companies are unable to provide a suitable exit option to the investor within the agreed exit timelines, then investors sometimes have the right to drag all the other shareholders in the company, including the founders, to a prospective buyer, and a drag sale is consummated. If you have any questions on the topics we have covered till now, we can take those up. Fine, are we good to proceed?
Yes, hi. So few questions that we'll start off now for you and Rajan both. Straight up, there's a question which is more on valuation overall, which says, how is valuation today affected for seed stage startups due to COVID-19? Rajan, do you want to take this?
Yeah, no, I'll take that. Good question. Look, I would say at seed stage, for what has happened is the parameters that investors are looking for has changed somewhat, right? I think at seed stage, quality of the team, this notion of founder market fit or founder product fit has always been important. Founder persistence, founder domain expertise, founder functional expertise, etc. That has always been important. I think the size of the market has always been important, making sure that the market's large enough to build a very large company. I think for companies that have launched, and the reason I say that is because you can raise a seed round before launching, a pre-launch company as well. So for instance, in Surge, in our second cohort, we had 6 pre-launch companies, right? But generally, I mean, a lot of companies that raise a seed round would have already launched and have some early level of traction. I think what has changed really is an even higher focus on customer love. And we talk a lot about that, what that means, how you measure it, etc. in our first and second parts of our series. But for companies that are actually post revenue, I would say the single biggest thing that has changed is, the lack of appetite for companies that have deeply negative unit economics, right? In many ways, in 2019, and I'd say for about 4 or 5 years leading up to 2019, it was, growth over profitability was really the mantra, right? In many ways, grow at any cost. And we saw a lot of companies, including some very large companies, get built. But that has changed dramatically. So that started changing, I would say, in the fourth quarter, or fourth quarter, calendar quarter of 2019. But today, even at a seed stage, let's say a company only has, I'm talking about a transactional business, right? You've launched, you've got, let's say you've got only 3-4% gross margin, and you've got just about break even CM1 and negative contribution margin 2. That company, it's going to be much harder to raise today. So I would say that is what has changed in terms. So what that actually means is, if you're a company that, for instance, is not demonstrating either strong customer love, measured by retention, things like ratings and so on and so forth. If it's a SaaS company, it's measured by churn. It's going to be much harder to raise today, right? And it's almost like, there's been a shift to quality, right? To find higher quality founders, higher quality, traction metrics, and for those companies that are getting funded today, actually valuations haven't changed, right? Maybe they've adjusted a little bit, but at seed stage, we're really not seeing valuations change. What has changed is the criteria. What it takes to get funded has changed, and quite frankly, the bar has gone up. So as a result, what you're seeing, that combined with the fact that, look, there is a lot of uncertainty still, right? India is at 7.5 lakh cases. We are heading to 1 million cases over the next 10 days, and then we'll probably be at several million cases come August. So we don't know, lots of other things about COVID. So the uncertainty combined with this sort of changing requirement has meant that, there are fewer companies getting funded. So fewer companies getting funded. The companies that are getting funded are much higher quality. But for the companies that are getting funded, valuations really haven't changed that much. I mean, there may be some segments here and there that valuations have changed. So it's a long answer to your question, but I wanted to give you that context. So I think what is really, really important today, if you're building a seed stage company, is focus on customer love, focus on solving a really, really, really significant problem, and make sure that your traction metrics indicate that you're building a viable business, right? So negative contribution margin. I don't know how many of you are building sort of transactional businesses that have negative contribution margin, even at seed stage. Today is not something you should really be. That's not a position you want to be in today. So, long answer to your question, but hopefully that gives some context.
Thank you, Rajan. Actually, the next question is also on valuation, taking it a step forward. Biggest concern for me while calculating the valuation of the company, beg your pardon, is how do I calculate how much equity is given per dollar invested? Is there a simple guideline to this?
Rajan, would you like to?
Yeah, Ashwini, I'll take a crack. I'll start and then you should build on it. Look, I think at every round of financing, except let's say a friends and family round, right? So in the first part of this webinar series, I talked about depending on how much you're looking to raise, right? If you're trying to raise 10, 20, 30, 40 lakhs, you should probably raise through friends and family if you're able to do that. Although there are angel investors who would invest that, and there are some seed funds or micro funds that might do that. Except for raising from friends and family, most other rounds, let's say you're raising through an angel syndicate, either on Indian Angel Network or let's say on Let's Venture, or you're raising from a seed fund or a venture fund, you should expect that you're going to between 15 to 25%, right, is what you're going to dilute in most rounds. And by the way, that applies until you get to about Series C. So you should expect that at minimum 15%, because any group of investors, especially if it's a let's say an institutional investor, or let's say some like a group of angels, right, to Indian Angel Network or even in Let's Venture, that's usually what we see at seed stage. So you should expect 15, 20, 25%. 25% is probably on the outside. At seed stage, ideally, you don't want to dilute more than 20%, because then you won't have enough equity to go around for your, let's say, Series A, B, C rounds if the company is going to require several rounds of financing. But let me, Ashwini sees a lot of term sheets across rounds, so let me have him build on that.
Definitely, Rajan. So, as you rightly pointed out, there can be multiple factors involved here, depending upon how much money the company is looking to raise. And obviously, investors would also prefer to have certain, shareholding to have, like as you can rightly say, a skin, like some skin in the game. So, keeping that in mind, we have, on an average, seen at least 15 to 20% dilution happening at Series A or Series B rounds as well. And obviously, with every passing stage, the percentage dilution keeps going down. But yeah, if it has to be determined just on the basis of the dollars which the company is raising, I think that would be really tough, because it would depend on multiple other factors, and not just the amount that you are raising.
All right. The next question is for companies in the conception stage, what are the legalities one has to keep in mind while applying for surge? Like what kind of documents? What are the guidelines here?
So again, I don't think it depends on the stage of the company, because some of the companies Surge has funded were not even incorporated when we agreed to make the investment. But yes, definitely in terms of documentation, which is shared by Surge, there is a very simple one-page term sheet, and there is a very simple 15-page share subscription agreement. It's not even a shareholders agreement, because we do not prefer taking too many governance rights, or too many, I would say, other rights like preemptive or transfer restriction at such an early stage as such. So our documentation is definitely one of the, I would say, simplest one being used in the market currently. The idea being, being to make the process time efficient and founder friendly.
Thank you. Let's move on and we'll take the questions again later.
Sure. Okay, the second set of rights which we would like to discuss in today's session are governance rights. As the name suggests, this obviously entitles the right holder to have some visibility as well as say in the day-to-day operations of the company, and some of the larger issues or corporate actions that the company would be undertaking. Uh, the most important one here is board seat, though it might not be very common for a lot of investors who take board seats at seed stage itself, which is also the case with Surge. We have seen a lot of other institutional funds and angel investors requesting for a board seat from seed stage itself. Second is observer right. Observers do participate in all the meetings and functions of the board, but they do not have any voting right. Once again, something I would say most of the investors do not prefer to have at an early stage, like seed stage. But yes, we have seen a lot of term sheets at seed stage itself, where institutional investors or angel investors have asked for observer seat. Third one is the affirmative voting rights or reserved matters. Affirmative voting rights entitle the right holder to have a significant say in some of, I would say, very, very key and material corporate actions in relation to the company. The standard affirmative voting rights might be in relation to future fundraise, any exit related event like listing of the company, or sale of the company or sale of material assets of the company, then hiring and firing of key employees. Uh, Once again, something Surge doesn't prefer to have at an early stage, but some of Sequoia's other seed stage investments would have affirmative voting rights as well. And most of the angel investors or seed stage investors do prefer to have certain affirmative voting rights at this stage. The last one, last governance right, which we would prefer to discuss here, are information rights and inspection rights. Uh, Obviously, the founders at this stage are, day to day, are in charge of the day to day operations of the company. Just to have some additional visibility on what exactly is happening at the company level, there are a lot of reportings which are required from the company. This might include your MIS or your quarterly reportings or your annual reportings, plus also giving the investors the right to inspect the documents and the books of the company, to ensure that all the information that they have been receiving as part of their information right is actually aligned with what they received. Uh, Moving on, some of the other key rights which you are likely to see in a seed stage term sheet. First one is preemptive right. A preemptive right entitles the right holder to maintain its shareholding in the company. Just to explain by way of an example, if an investor is holding 10% shares in the company and the company goes ahead for a future fundraise of say $10 million, and the right holder was also holding 10% earlier, the right holder will have the right to subscribe up to 10% of the future fundraise to ensure that its shareholding doesn't go below 10%. It's generally pro rata entitlement and a right to ensure that there is no unnecessary dilution of their shareholding. Now, transfer restrictions. Transfer restrictions primarily apply to the founders, other equity shareholders, including employees, if there are any, and then the early stage angel investors as well in some cases. The idea is pretty straightforward here. Investors have backed the founders, and they obviously want them to continue for some reasonable time in the company as a shareholder, so that there is enough time or reasonable time frame to build the business. That's why early stage companies we have seen lock-ins starting from 4 years from the date of investment all the way till an exit is provided to the investor. Uh, then there are other transfer restriction rights like right of first refusal, which is also called ROFO, right of first offer, and tag along right. Right of first refusal entitles the right holder to buy the shares which a founder or an equity shareholder is proposing to sell by simply matching the price at which someone is willing to buy those shares. And right of first offer entitles the right holder to offer a price if they are willing to buy those shares upfront. And in that case, if the proposed transferee is willing to transfer their shares at that price, they can transfer to the right holder. Tag along right entitles the right holder to part sell certain of their shares as well along with the transferee. This is generally calculated on pro rata basis. Say, for example, if a founder is selling 5% of its shares, the tag along right holder will also have the right to transfer 5% of the shares along with the founder. And the founder or the seller will have to make that transfer happen. Uh, Moving on, some other key terms which are, I would say, not very specifically but to some extent referred in the term sheet, and they are left to the standard market practice. uh, the first one, which is very very important for the founder, is founder share vesting. As I mentioned earlier, the investors are backing the founders, and they obviously expect them to spend some reasonable time in the company to give an opportunity to the business to be built, at least if not grow. To ensure that there are vesting schedules or share vesting conditions imposed on the founder shares. Generally, we have seen this ranging, or rather, starting from 4 years and sometimes are even longer. And with every say every passing quarter or every year, the certain percentage of shares get vested in the founders, and then they are entitled to the economic interest in relation to these shares. Till the time the shares are completely vested in the founders, their transfer or any economic benefit in relation to these shares cannot be enjoyed by the founder. That's a key point there. Then moving on, non-compete and exclusivity. Exclusivity once again, highlights the importance of the founders, and the investors expect them to invest all their working time in relation to the business the investors are backing. If in some cases, or I would say at later stages, there are certain exceptions provided to this exclusivity obligation. But in early stage companies, the founders are expected to invest all their time with the investee company. Then there are non-compete restrictions as well, as founders are not expected to invest in competing businesses or being associated with any competing business, whether as an advisor or as a shareholder, while they are shareholders in the investee company. This is to ensure that the interest of the investee company is protected. Then yes, there are a lot of business warranties which are required to be provided on the basis of which the investors make investments. These might range all the way from day-to-day compliance with the legal requirements or fulfilling all the obligations that the company has signed up to in their commercial contracts, and there not being any major breach or legal claims. And then there can be some specific warranties as well, which are generally identified during the due diligence process. The warranties are backed by indemnities. This is the right which investors prefer to have. So, in case there are any major breaches or any major non-compliances which come to light post the investment is made, investors would prefer to have a right to get their investment amount back, which is primarily covered by indemnities. Uh, Pile, any other question at this stage?
I think let's just finish your section and then we can take a couple of questions.
Sure. Moving on, the next one is simplifying term sheets, or if I have to rephrase this, how Surge has tried making negotiation and signing of term sheets as well as definitive documents easier and time efficient. So instead of standard 3-4 pages or complicated term sheets, Surge has opted for a single one-pager term sheet which only talks about some of the economic rights we discussed earlier, most of the governance rights, including affirmative voting rights, then board seat, observer seats, and other rights like exit rights, transfer restrictions. These are all left to the next round. And depending upon how the next round is being structured, these rights are either introduced or elaborated at that stage. Similarly, the shareholder or the share subscription agreement which we sign for Surge transactions is a simple 15-pager instead of the lengthy 50 to 100-page documents which are common at seed stages, or definitely at Series A or Series B stage. The idea is definitely to keep the process simple and company friendly. Even other seed investment that Sequoia makes, we are also using a very simple process and simple documentation. Economic rights, as I mentioned earlier, for such transactions, it would generally be a straightforward 1x non-participating liquidation preference right and a broad-based weighted average anti-dilution right. Representation and warranties are also very diluted and broader form. The last slide or the last point which I would like to discuss is the transition from the term sheet to the SHA before we get into discussion about the legal or the financial due diligence process. So a lot of founders get the feeling that if we have signed the term sheet, the investment round is more or less over. But to their obviously, the reality is the documentation process has just started. Term sheet is definitely a non-binding indicative term subject to which an investor is willing to make the investment. The certain detailing part comes at the shareholders agreement stage, or the share subscription agreement which we use in Surge investments, which is a legally binding document. So founders should not get surprised if the term sheet or one-page term sheet is followed by a lengthy, detailed shareholders agreement. This agreement sets out all the terms in detail because there are a lot of processes involved, and then a lot of decisions are taken pursuant to the due diligence process, like conditions precedent are added, conditions subsequent are added, or there are some covenants which the company is expected to fulfill during the time the investor is on the cap table. This would range simply from some basic regulatory compliances to some licenses or approvals which a company is required to take, but they haven't taken at the time of the investment or at the time of the term sheet stage. And then there is a possibility that basis the due diligence process, the commercial terms are also revised. This may also extend to the valuation or the shareholding and some other key obligations which can be imposed on the company in relation to their business operations. Then the key aspects which one should keep in mind while reviewing or going through an SHA is that the first and foremost rule is setting of precedence, because in most of the cases, at least what we have seen is the seed or the Series A document survives in some form or the other till the exit of the investors, and this may range anywhere from 7 to 10 years as well in some cases. So that's why one should be very very careful what they are agreeing to, and if there are any wrong precedents being set, then it becomes difficult to renegotiate those at a later stage. Then with a lot of time, what happens is some of the rights are like unintentionally extended to some other clauses like liquidation preference. We have seen, or even anti-dilution protection. We have seen in a lot of cases where sometimes liquidation preference rights are connected to the specific transfer of shares by the investor alone, and which is contrary to the principle of distribution when the company is going towards a corporate liquidity event. Similarly, anti-dilution protection, people sometimes or investors connected to the listing of the company, that at the time of listing of the company, whatever is the valuation you get, if it's lower than our investment price, then we are entitled to anti-dilution protection. That too, sometimes we have seen getting extended as full-fledged anti-dilution protection instead of broad-based. And then direct indirect block rights, sometimes a clause as simple as the amendment of shareholders agreement or the share subscription agreement entitles every signatory to the document to have an indirect block right on any future change in the document, which becomes a bottleneck at a later stage. While I think we can take a pause here, and
Yes.
we can take some questions.
Thanks so much, Ashwini. A few questions before we move on to the financial section of this presentation. The first one is, what are your views on convertible notes? Do investors prefer CCPS rights?
Sorry, which rights?
Cumulative convertible preference share rights.
Got it. So, first of all, convertible notes, definitely, in the interest of time, or sometimes, if not in India, at least in other geographies, a lot of investors are okay and comfortable investing through convertible notes. To be honest, Surge has also made a lot of investments through convertible notes, because the valuation, which is the most important point at an early stage, is already set out in the convertible note or connected with the next round valuation. So investors are comfortable, and what we have seen, at least in the last 2 to 3 years, the acceptance of convertible notes has definitely gone up. Investors are becoming all the more comfortable, and if the the key aspect or key interest of the investors at such an early stage is not governance rights, then convertible notes serve the purpose well, and that's why a lot of investors are getting okay with that or comfortable with that. And Payal, what was the second part on the CCPS, right?
Yes.
So compulsorily convertible preference shares, again, that's the most common form of security which is used. Obviously, this is primarily because of the economic rights which investors prefer to have, and the flexibility and the economic benefits the preference shares offer over equity shares, be it in terms of enforceability of anti-dilution terms or the conversion mechanism, which we earlier discussed, like downward adjustment of the conversion price. All that is only possible if you are holding convertible instruments. That's why preference shares play a very key role there. And honestly, in India or Singapore, we haven't seen too many investors opting for equity shares upfront. Maybe late stage companies, where the business is already established, the business metrics are set. Then yes, it's possible for someone to go for equity securities. Otherwise, the preference for the market has been for a very very long time to go for preference shares.
Thank you so much. Couple of more questions before we go on to the next section. This one is from Siddhant, who says, what is the anchor for structuring deals? Is the thumb rule of 15 to 25% dilution is the thumb rule of 15 to 25% dilution and valuation based on the capital ask, or does valuation and the ask govern the dilution?
I think in some form we already covered this. And Rajan, would you like to take this up on the valuation and dilution?
Yeah, I think, look, there's no science to there's no right answer to this, right? So I'll tell you, look at a seed round. Let's say you're raising. Let's just say, by the way, maybe I'll combine this with one of the questions that was asked around Surge, and I'll sort of tell you about that, right? We have at Surge, we invest between $1 and $2 million. It could be one, it could be 1.5, it could be two. That is from Surge, and then, as I said, a lot of our companies also have other co-investors. Could be another seed fund, could be angel investors who invested in the company that our founders want to have come in, right? And we have a fixed price valuation. So the company valuation could be $5 or $6 million pre-money, or it could be low double digits, could be 10, 11 million or whatever, right? So it's a range, and quite frankly, it is unlikely that you're going to get a seed investor, whether it's a Surge, another seed fund, or a venture fund that's investing in a seed round, or even, let's say, an Indian angel network round where you're going to dilute only, let's say, 3, 4, 5%. That's almost like it'll be very, very unusual, right? The 3, 4, 5% dilutions happen after you get to Series D, E. When you've got a valuation that's $600-700 million, you could raise $50 million and dilute a couple of percentage points. But at seed stage, you will be diluting. So the way you should, and by the way, those of you that have not attended part 1 and part 2, and even part 3, please do attend that, because we talked about how should you think about how much you want to raise, right? The last thing you want to do is determine how much you want to raise by how much you want to dilute. Right? How much you want to raise should really be dependent on the set of things that we talked about in the first part, which has to do with what does it take to get to your next milestone, right? And by the way, if you can actually get to your next milestone with either self-generating revenue, by becoming revenue positive, or capital that you raised, let's say through a friends and family round, then that's always much better to do. But use those set of lenses when you're trying to define how much you want to raise. And then first you define how much you want to raise, then you define who you want to go to, depending on how much you want to raise. And then depending on who you go to, that determines, as I said, if it's an angel network, if it's a seed fund, if it's a venture fund doing Surge deals, or if it's a program like Surge, the numbers will vary, right? So I think there was also a question on Y Combinator. Y Combinator, basically $150,000 plus you get to Y Combinator program, which is terrific, but they take 7% of the company, right, for $150,000. At Surge, for instance, we will invest $1 to $2 million, it's a 10 to 20% sort of that range, maybe slightly higher, slightly lower, but it's in that range of for $1 to $2 million, right? So hopefully that gives you a sense of how this sort of works.
Fantastic. Thanks, Rajan. You've actually answered the last question that we had. So, Ashwini, unless you have something to add, I think we can move on to the next segment.
Definitely fine. We can move to the next session. Thank
Perfect.
you.
Thank you, Ashwini. And
Thank
now
you,
let's
Ashwini.
Thank you.
Please stay on for Q&A towards the end as well.
Yes.
Can you see my screen, Pal?
It's just coming up now.
Can you put it on slideshow mode? Okay, there you go. Perfect, Sandeep. You're on.
Cool. Thank you, Rajan. Thank you, Ashwini. I'm sure people would have found that very insightful and a lot of takeaways. Hi, all. My name is Sandeep Kher. Rajan already introduced myself, so I'll probably not spend much time on that. I'm so glad that I'm amongst all of you and appreciate you taking our time. I think this is a great initiative by Startup India, Invest India, and Surge to broad base how to build the startup ecosystem. I'm glad to be playing a little bit of part in this. In my current role at Sequoia, I also manage Diligence that get commissioned from our end. I also have had the good fortune of being on the other side of few diligences myself. And today, what I'm going to do is try using my lens of being on the both sides of a table and demystifying a little bit about how the due diligence process works. Business speaking wise, due diligence process is often referred to as DD. Very simply put, DD is a process of ascertaining the price that you are paying. Is it worth it or not? And before I kind of get into my presentation, let me maybe elaborate on that point a little bit. Let's assume you want to buy a second-hand car. What would you do to satisfy yourself that the price being asked and the price that you want to pay is that's right? I mean, how do you get to that process, right? The first thing you would want to do is you would like test drive the car. You will make sure it's driving good and not just looking good. You would want to find out if the title is clear and the service record is clear. And given the size of the transaction, I mean, generally second-hand transact cars are not that expensive. You would probably do all of this yourself. Now, let's take another example. Let's say assume you want to buy a house, right? Do you think the checks and balances that you would want to play out would be similar? I think the answer is no, right? And you would spend far more time, going through and far more resources actually going through the title deeds. You probably have a Vastu consultant come and check the day of the house. You'll have a surveyor coming in. You will probably want to go through the schedule that's given in the title papers. You will want to go to the ministry and the government office records to check, in whose name the house or the flat is. So you'll probably spend far more time. You will also want to check the antecedents of the seller, right? So the process of buying a house is probably far more elaborate, and you will take abundant measures to satisfy yourself before signing on the dotted line. Similar is a diligence process, and you end up spending that time only to verify that before you write the check, everything is in order. The thing about business is that it's full of challenges, it's full of problems, and the process of diligence really is to identify those issues and make sure that the investor is aware of them sooner than later. I'm not suggesting that all the tidbits are important, but the focus definitely is on the material items. It's an in-depth process to really understand about the business, and more so about how the business has been conducted. It's a process of verifying information, explanations that you have told about the company, and that's why they say that please be careful of what you say. Validating all the things that the investors have heard from you. Everybody knows, and realistically speaking, everybody knows that startup, when they start, they're not run the most perfect way, right? And the idea of a diligence is not to understand everything that has happened in the company, but it's more about validating that the risks, that you're not taking more risks than you are aware of. You don't want to be in a situation where a problem is not known to you. And that's the diligence process. It's about validating everything that's been discussed with the investing team all up till that point of time. With that, let me deep dive into the few slides that I put up. And I want to talk about diligence phase to begin with. The basics of diligence. I mean, and I tried, laying out that in with an example or a couple of examples in terms of illustrating why do you do diligence, right? You are verifying all the information that you shared during the process up till then. Collaborating, the diligence team will collaborate that with going through your financial statements, your bank records, going through all the other necessary detail, customer contracts, etc., etc. When is diligence commissioned? I mean, I think Ashwani alluded on that. The start of the diligence process is after the term sheet or the LOI is signed. Generally, diligences are commissioned. I mean, the finance, legal, and tax diligences are commissioned by outsourced service providers that people use. It could be the Big Four, the Big Eight, and firms all across. Commercial diligences are normally done by the investing team, and typically the diligences are led by the lead investor. How do you go about doing these diligences? We rely on an information checklist, which is given by the service provider, and then you start uploading all the information into a virtual data room, and that becomes the central repository of everything that you want to share with the diligence team. A significant time is spent outside. Still, I mean, like, you will have calls, meetings, etc., etc. A lot of interaction on emails, and that's how mostly documentation, or discussion and queries do get responded to. So in a nutshell, I just thought I'll probably lay out before I deep dive into this in terms of what are the basics of diligence, and broadly how do you look at it. In terms of key components of diligence, I mean, like, and I'm going to talk about more from a startup phase, a very early stage company, and not really from a company which has become a little mature, because then the gamut of things that you do undergo are very different. uh, Essentially, in an early stage company, you just want to make sure that the health and the hygiene is there. The key KPIs that are you looking at are panning out. There is not too much of cash transactions, because all investors worry if there is too much of cash flowing in and out. Also, one of the things that you want to guard against is that the founders or the core team's hand should not be in the cash still. And companies generally followed a reasonable level of governance in the organization. And similarly, around areas of tax, I mean, like, you just want to make sure that the hygiene around compliances is there. You have had the practice of filing your returns. There is synchronization between your financial statements and your tax returns. Often, we find that that's not there. And the legal diligence, talks, wants to review the compliance that you have with all laws and regulation, checking of your cap tables, the contractual terms, what kind of agreements have been entered with the founders, your customers, your vendors, and so on and so forth. So broadly, at an early stage of a company, you would look at financial diligence, tax, and legal, and the bulk of the time is spent on financial diligence. If I were to allocate time, that's where probably the energies lies. The important aspect is to make sure that the revenue that you showed at the time of commercial diligence is there recorded in the books. It's just not revenue which is there in the books, but it is also getting collected. Also, the working capital cycles are not elongated. At that early stage, you don't really focus so much on economics. But as Rajan was alluding to earlier, times have changed. People now want to put money in businesses which are, economics are favorable. So, with that increasing shift towards economics, you will realize, and you will hear that investors want to focus on those things. And how are you then at that point allocating your cost to determine what your margins are? Because I think that also is a question that investors like to understand, that how much of margin attribution is on account of real business performance, and how much is on account of accounting practices. I want to spend a little bit of time on preparation for diligence, because this is where you could actually get it very right, or you could go horribly wrong. And I think the first and the foremost is explaining your business. And often what happens is people believe that when the diligence team comes, they have very good understanding of business. It's a fair expectation to have. But what happens is that hearing it from the horse's mouth is always better, and they get a good sense of what the business is all about, who the customers are, how your contracts are written, how the transactions get recorded, what are the strengths of your businesses. And not only that, I think you should use this opportunity of management presentation with the diligence team of being very candid and sharing all the details of the company. Because the biggest surprise that comes out of diligence is not on account of what the diligence team finds. It's on account of things that probably founders or core teams do not explain, or sometimes inadvertently do not think that's important, and those then become very material from an investor standpoint. So I would lay stress on the fact that please make sure that you take out that time, make sure that the first step, which is the most critical step in the diligence process, that people are made aware of the details of your company, how things perform, what are your KPIs, how do you measure performance, who are your customers, share about some of the things that you think probably are not material, especially around related party transactions, cash transactions. Those are the things which make investors squeezy. uh, and if these things come out in the wrong, I think we have seen instances where people have taken a step back, and I'll probably illustrate that more as we move forward. I think the other bit is on data integrity. And what I mean by that is, what happens is, at an early stage, as I was alluding to earlier, people don't often, have things which are very tightly stitched. You may have contracts, you may have signed, but you may not have invoiced, for example, and you may call that into as revenue. But what happens is that when people come for diligence, they would never include that as revenue, because you may have signed contract but you never invoiced, and therefore, if you've not invoiced, the other person has not acknowledged the receipt of services, and by that, what it means is that they're not bound to, or they're not supposed to pay you the money. So data integrity around things like this is extremely important. Linking of contracts to accounting information, and then ensuring that same consistency flows into your bank statements as well, is a very important vector that you should be cognizant of. I think the other bit, and I touched upon it, is cash transactions, personal expenses. I think people don't realize, and with all good intention, sometimes these things become a problem. And we've had situations where companies were doing all the things with good intention, but then it became a big problem. And the reason for that is, and I don't know how many founders pay attention to some of the tax laws of our country, that certain cash expenses beyond a threshold are not allowed as deductible expenses. So what that means is, if you've incurred some expenses in cash and you made some good or service out of it, and you received your collections or your revenue, the tax department is today bound to disallow that expense. And what would happen is that in an early stage, you will be construed or viewed as a profitable company, whereas the reality is that you would have not made a single penny on the business that you've written. And therefore, you may end up burning more cash by paying taxes on account of this particular aspect that you would have overlooked. So that's one thing that you should always refrain from. As soon as you start a company, please make sure you have a company account. Please make sure you route all your transactions through that. Do not encourage cash. That's seen with a very different lens. I think after you've gone through the steps of explaining the business to the diligence team, sharing with them all the things that they should be made aware of, good or bad, the next step is preparation of virtual data room. And that's essentially a most important step, because all diligence teams dive into that, and it is a most important place for upload of all your documents. It's also a good practice from confidentiality standpoint. When you upload customer contracts, there's client confidentiality that you want to protect. Therefore, you don't want to be using emails and start throwing data around all over the place. Virtual data rooms, these are very secure. You should upload data over there, and make sure that you follow the RL which is shared with you right at the start of the diligence exercise. I think openness, we spoke about that just make sure that you have free flowing conversations, not just from a standpoint of explaining and sharing about business, but also if you think that the diligence team sometimes are going off track, don't assume that this is all par for course. You should pick up the phone and talk to your investors. You should pick up the phone and talk to the diligence team lead, and explain to them that you probably are going on the wrong path. And it's not uncommon to have been in those situations. I think last but not the least is the partners that you work with. Uh, Please ensure that you are working with people who understand the startup ecosystem, and not with people who think of a startup as a conventional business, who think it will have everything in place, and therefore pulling out all the records and all the information in any possible manner would be very easy. That's not the case. Our experience tells us otherwise. So please be very careful with people that you partner with in the diligence exercise. With that, I'll probably move on. I'll move on to some of the concerns that normally come, and I'll break this into into two parts. I have the business and the financial section, and then I have the legal section as well. I think the concerns that we typically see, are around reliability on financial statements. People have prepared financial statements on account of cash basis. All serious financial investors that come on today to write a check, they would want you to follow GAAP accounting. By what I mean by that is that accrual basis of accounting. So if and to illustrate that point, so for example, if you incurred an expense but you're not paid, for example, your staff salary, that doesn't mean that you will not recognize that in your P&L, because that liability will come at a point in time in later, and you still have to pay that. And investor should know about it, because he's putting in the money assuming that you've taken care of all your past liabilities, but he may, during the diligence process, may realize that a large part of all the expenses that had to be paid are not paid. I think diligence also tries to understand how the revenue and the margins are flowing, how the cash is flowing. Is the business a viable business? And it's very important in an early stage to demonstrate to the diligence team that the unit economics are on the right trajectory. They are improving, and it's very important for founders to establish the right way to determine the unit economics. We've had instances where people have captured unit economics in an incorrect manner, and that has led to discussions and deliberations on the commercial terms. Similarly, on customer metrics, I know at an early stage, you can't achieve all, but it'll be good to have a lens on this as well, in terms of essentially, if you are testing for product market fit, how's your customer retention? What kind of complaints are you getting? Are you reducing your price with every single discussion that you have with your customer? What's your cost of acquisition, your LTV to CAC ratios? I think those are important metrics. They may not be the best in class given the life stage which you are in, but the important thing is to make sure that they're moving in the right trajectory. Poor governance on account of not just on account of cash, but even on account of things like related party transactions, not being at arm's length, you taking significant favors from people, and not disclosing that upfront, withdrawal of funds for personal use, are all things that are looked upon, very, very, very negatively. And I would urge all founders, early stage founders, to completely stay away from it. Common concerns around legal and compliance. I'll probably pause at this moment and request my colleague Ashwini to speak about this.
Thank you, Sandeep. So, in terms of the legal and compliance areas at an early stage due diligence process, the first and foremost is the regulatory guidelines. A lot of companies which are proposing to or are already in regulatory sensitive sectors, be it insurance, fintech, or any other business which requires prior government consents, approvals, and most of the cases the business operations are already started, while some of these approval processes are not completed. So from legal diligence perspective, that becomes very, very important, that before the investment amount is transferred, or the amount is invested in the investee company, all these things are in place. Then similarly, something as simple as maintenance of corporate accounts, or corporate filings which are required to be done with ROC, or for that matter RBI. If those are not done prior to the investment, then obviously that takes the or rather makes the process much longer. Second one is intellectual property. Why this is important is because of late we have seen a good percentage of founders who have left their have left their jobs and started businesses which are more or less similar to what they were doing earlier with their earlier employer. and that becomes a challenge. I mean, nobody looks at it from day one as at least the founders don't look at it from day one as something which can impact their future investment or their future business operations. But these things can be really painful if the past employers they start coming after the founders for either non-compete or non-solicitation breach, or utilization or use of IP, intellectual property, which they think the founders developed when they were working with the earlier employer, or utilizes some intellectual property which is owned by the earlier employer. These can result in long-lasting litigations, and obviously, any incoming investor would not prefer to get into that situation. This also extends to some standard trademarks, or the business names which the company proposes to use or is already using if the business operations have started. If some third party is claiming a right to these trademarks or intellectual property, then also something which becomes essential to be resolved prior to the investment is made. Then there are a lot of contracts or early stage contracts, especially between the founders, or if there are already some shareholders in the company, they have signed any shareholders agreement. All those have to be evaluated to check for any clauses or rights which can become problematic in the long run. And those are also included in the legal due diligence analysis. There are a lot of other aspects as well, which are very thoroughly checked, and every investor would definitely check before the investment is made. Be it the structuring of the company and its group companies, because we have seen a lot of early stage investments as well. There are holding company and subsidiary company structures, and they all are operating sometimes in different geographies, so different sets of laws apply. And then it becomes very important as part of the legal due diligence process to verify that these structures can be actually utilized by the company for its business operations and are kosher from foreign exchange or other non-compliances. Then capitalization, like something like the capital structure of the company, which we touched upon partially when we were discussing about agreements, how the company issued the securities, what are the rights which are attached to the securities, is the cap table which is reflected in the term sheet, or which which was shared with the investors at the time of initial discussion. Is it aligned, and are all regulatory compliances in relation to issuance of those shares have been done already or not? Then if there are any major litigation issues or claims or disputes at an early stage, uh, what stage are these disputes, and can these disputes be easily resolved, or can they pose a threat to the business expansion at a future stage? On that note, Sandeep, over to you.
Thanks, Ashwini. I probably wanted to use this opportunity to illustrate, to you guys, how in some of the situations things have not panned out as they would have been, and this is an example of a potential investment that we were looking in a logistics company. Company was at an initial stage that was made to for us to believe was that it was growing at a rapid pace. It had strong customer retention, a very strong engine of sales engine. They were acquiring customers, and this was the next good thing to happen in the logistics space. When we undertook the diligence exercise, we realized that there was huge dependence on just one specific customer, um, and and that was obviously, in hindsight, yes, we can all say this, that we found that. But during the course of this conversation, we figured out that uh, the founder had not disclosed this material fact. He kept talking about how the growth of the company has been, how the margins are improving, and business is expanding. But during the presentation that was made to the investing team, at no point in time, did the founder explain to the team that there was significant dependence on this one particular customer. Also, the the founder did not disclose that there was a related party angle that the customer had with the company. you know uh, I'm not saying that you cannot have related parties be with you, but it's important to disclose, and it's important to maintain an arm's length basis of transaction. And I think those are two things that really didn't go well, in our diligence process. And we went back to the table to discuss the term sheet, uh, and based on the findings that came our way, the modifications were suggested in terms of the investment amount, and so on and so forth. But during the course of those conversations, we realized that probably things would not come to common ground, and we had to move away from that particular deal. In another instance, this was an offline consumer brand that has been operational for a few years, was being valued at about $50 million. And the investment was predicated on the fact that in terms of how product expansion is happening, how the growth has been, how the distribution channel is expanding, and so on and so forth. And during the diligence phase, we figured out that a lot of the sales that were happening were, in our parlance, what we call as dumping, was attributed to that, with not real great customer offtake at the last mile. Also, a lot of growth was attributed to new geographies and newer distributors that you were doing. And because of the dumping that was happening, the other problem in the business was that there was huge amount of accumulation of debt that was happening. And it was not clear to us as to how the company would be able to get the monies out from the long tail of distributors that created over the journey. And what we did as a consequence was we went into two specific discussions post the diligence with the company. The one was, as you would expect, was a reduction in value, and the other one was we had to escrow our funds, which were contingent upon the collections happening from the distributors or the company's customers. What was made out to be a $50 million check had to be the valuation had to undergo a revision, and at the same point in time it was tranched. I'll pause at this stage and check with Payal if there are any questions.
I think we can take a couple of questions and then move on for the last bit. So this is about, it's a question on what do you look at for due diligence at seed level when a company is not yet registered?
Mm-hmm. So actually, it's a very light touch diligence. If the company is not even registered, going back to my example of buying property, you really only at that point of time check about the founder and nothing more. I mean, because the company is not really into formation, so there's nothing much to check. But you go and do a little bit of founder check. You talk to people who are part of that community ecosystem. Talk to employers, past employers, talk to peers. How do they, what do they feel about the founder? What do they feel about the idea? And the so it's a very light touch diligence to answer very specifically.
Yeah. And
just to build on that, what Sandeep said, we have quite a number of our search companies that are pre-launch, and some of them actually, as both Sandeep and Ashwini said, haven't incorporated yet, and we entirely focus our diligence on the founders. So we do extensive founder ref checks. We spend a lot of time trying to get to know them, understand them, what their motivations are. We obviously try to deeply understand the insights that they have, how they're thinking about building the business, whether the co-founders seem to get along or not, if they're co-founders on the team. So it's really the founder, and then we also spend a fair bit of time trying to understand the market, right? So in a pre-launch company, we are basically making a bet on the founding team, but we also we have to have a lot of confidence that the market that they're going after or the specific problem that they're trying to solve is real. So we'll do a lot of market analysis that we would do, and obviously we would get whatever data the founding team has. But that's what that is.
Yeah.
Yeah,
Thanks,
and just
Sandeep.
to add to that, at least from legal perspective, though as Sandeep and Rajan mentioned, we keep it very light. But if you need any waiver from your past employers, keep that handy. That always will be asked sooner or later. Plus, if the proposed business activity is regulatory sensitive, what are your plans in relation to that? That is something we definitely check because some licenses may actually require past experiences or some qualifications. If those are handy, these things can be helpful in the due diligence process.
Okay. The next question is for Sandeep and Ashwini. After signing the LOI, suppose the founder knowingly or unknowingly does not follow compliance or corporate governance properly, what are the possible consequences of this?
I mean, I see there are no easy answers on this one, quite honestly. But I think my view also from day one has been, explaining the situation that you're in and helping people understand as to why that happened. Because nobody is there to second guess you. I mean, if you disclose this upfront, people will be far more appreciative of where you are in the journey and how they can work with you to fix it. So I don't think so. People should be alarmed if they have taken a wrong step or a wrong turn, because all of us have don't come with that experience that we would get it right from day one. But what is the most important thing is to be candid, share all of this upfront, and work with your investing team, their peer, their colleagues, their diligence teams to help you navigate through those situations and find a long-term solution to the problem that you're in.
Yeah, I think being transparent is the most important part of the diligence. The efficiency of the diligence as well as a fast closure, a time efficient closure, is completely dependent on that. Because sooner or later, the advisors who are, be it financial advisors, legal advisors, they will figure out if some of the compliances are missing. And to be very frank, most of these issues can be resolved in very short duration. So that's why deal closures, take 2 to 3 months, and sometimes maybe 4 or 5 as well, even for early stage transactions. If you are transparent, then the solution can be easily figured out. If you are open about things and if you are willing to take the corrective actions, in short time frame, most of the issues can be resolved.
Sure, thanks. One more question, and then we should go on to the final segment. In the case of a seed round for a 100% subsidiary, do complicated shareholder agreements of the parent company become a challenge for investing in the subsidiary?
Maybe I'll take a crack at that, and then Sandeep and Ashwini should add. Right? I think, look, investors generally like to invest in quote unquote clean cap tables, right? That are not complicated. So to the extent possible, if you can carve let's say it's a division of some company, right? Or division, or some subs, you created some, taken some IP or some resources from a parent company. Try to create a clean separation, right? Where, let's say, the parent company owns X percentage of the of this new entity, and the key resources, whether it's IP, whether it's technical talent, whatever it is, whether it's a brand, try to separate it and create a clean cap table, right? Because having complicated SHAs between a company and another company at a seed stage is something that we would, most investors would kind of worry a little bit about. But let me have Sandeep and Ashwini add to that.
Yeah. No, sir, Rajan, absolutely. And that the first preference is that the cap table is clean, and the structures above are not very convoluted, because you can then run into issues that, and as Ashwini was alluding to earlier, that whatever you're signing for could be a problem that you carry for long term, for the next at least 7 to 10 years. So it's important to get into that. In disengagement, let's assume, for lack of a better word, from the parent that is there sitting on the top, and figure out a way to deal with it. Ashwini and our legal team have spent a lot of time doing that. We have those situations, and we do encourage founders to think about it on day one itself.
Yeah, I think clarity of rights as well as cap table from day one is very, very important. As Sandeep just highlighted. So, uh, for business to be, actually reach the exit stage, or where, the founder and the investors want to take it to, it's definitely going to take, 5 to 10 years, and maybe even longer. At that time, you should not realize that something which you should have corrected on day one is still an overhang, and can impact the business operations as well as the value. So the sooner you resolve it, the better.
Thank you. Conscious of time, so Sandeep, maybe you just want to present the last segment, and then we'll take one final question and wrap.
Sure. Thanks, Payal. I'll probably, and I'm cognizant of the fact that we've spent a lot of time more than what was budgeted. I'll probably move on quickly, but just wanted to share the thoughts with you, our thoughts with you on post-deal phase. That still the signing of LOI, and then from there diligence are probably actions that happen once, but thereafter you have to engage with the investors on an ongoing basis, and the teams as well. So please make sure that you are prepared for that journey, which is going to be a longer journey, a much longer journey, and a fruitful journey that you will be embarking on. And therefore, it's important to be ready for that particular phase. And essentially, I think the first thing that I'll talk about is that use that diligence exercise to holistically look at the business around all aspects. For example, what's missing in your contracts? How can you make sure your contracts become more tighter? At an early stage, maybe the customers are putting a heavy foot and they're bargaining, but maybe you should start moving the needle and start making some of those changes. How your accounting function is not working right, how your retention is looking like, how you're measuring your CAC, how you're reconciling balances and all. So use a diligence exercise more holistically. We often encourage our founders to spend time with us to go through the learnings that they can take from the diligence, and put a corrective action plan very soon into the business. I think once that's done, the biggest step I would say that all founders have to embrace is how do they leverage and build on their relationship with the investors. Investors come from a place or a vantage position where they have access to a lot of insights, a lot of information, a lot of probably common issues that founders face. And given their vantage point, I think it's important to start embracing them as partners, as sounding boards who can help you navigate through situations, can open doors for you by connecting with people, and also at the same point of time help you build that team and get to a level of trust sooner than later in terms of how to run the business together. I think the third point that I would want founders to focus on is performance tracking. I think it becomes very critical. You are now part of a group which looks at all these numbers very closely, and they have people who are spending time day and night on analyzing performance. So it will be important for the founders and the team to make sure they put time and energy and effort behind it. And it's not just for investors, it's for their own business. If they are able to measure how the economics is, then only they can make the change. If what you can't measure, you can't improve. You should know what your cash position is. You should not be sitting 2 months down the closer to a situation where you run out of cash. You should be able to guide your investors to that place, saying that, okay, this is how I'm envisaging my cash to play out, and the investors can then handhold you in terms of the next fundraise that you should be doing and setting you up for that. So it's very important to have a very strong control on your operating and financial performance metrics. Cash flows, I spoke about it. How are your working capital cycle, playing out? That's very important. What happens is people start looking at metrics like revenue, but the conversion of that revenue to cash is very important. How much time is it taking for your receivable cycles to turn around? Are you leveraging your payables, as much as you could? Because if you're not doing this well, you'll always be constrained to grow the business, because your cash is getting stuck in the channel with your customers, and you will not be able to, without getting more capital, you'll not be able to drive business forward. I think, and the last thing that I would touch upon is shareholder communication, engagement. Keep investors informed on anything that impact their rights, the cap table, any significant item that you think could have an impact on the business. I think those are events that you should very quickly take to your investors, to your shareholders, and bring them up to speed. And as we alluded to earlier, during the Q&A, that use them as people to help you find solutions, than be worried about the fact that they'll be more worried about finding the reason as to why this went wrong. I think that's not what the investor community is focused on ever. They want to find solutions and work with the companies to build them and scale them as we move forward. I think very quickly, from a key takeaway standpoint, while we've discussed all of this, but and it's on the slide, but what I would like to say is why diligence is important is so that the buyers feel comfortable that his or her expectation from the proposed transaction is going to be met. Without diligence, it increases his risk or exposure, because there is a fear of unknown, and therefore the diligence exercise is undertaken. I think from a seller's perspective, what I would focus on or guide all founders to focus on is make sure that there are no surprises, because that often collapses the transaction due to loss of trust. So you'll always be well served if you prepare for your diligence and not take it lightly. As we spoke about the post deal, I think focus on getting sure that you close your CSS soon, establish that rapport with your investor and their teams. They have extensive experience. They have knowledge and insights coming from businesses all around. They'll definitely be able to add more value to you. I'm sure you will run a very successful and a fruitful organization as you all move forward once these things are taken care of. With that, I'll end and happy to take questions at this stage.
Fantastic. Bye. Thank you. Conscious of time, and thank you everyone for staying on for so long. We are going to take exactly 3 questions and then wrap. The first one is a broader one, and perhaps Rajan, you would want to take this. Subhash is saying we would like to have more investors in a given round for diversification reasons. This will result in smaller equity opportunity for each investor in each round. What is your take on such participative investment? Do you feel other participating investors are competition for you, or do you think it is a good thing and can help bring in more investors?
It's actually a very good thing. As I said at Surge, 80% of the companies that come into Surge, right, have co-investors with them. So what I mean by that is Surge would invest 1 to 2 million from Surge, but then either other seed funds, venture funds, or in some cases groups of angel investors, angel networks would invest. So it's actually a good thing to actually have several investors, in some cases many investors. But one thing I would urge all of you to think about is make sure that every investor is there for a reason, right? Either they can, obviously, firstly, if you need to raise around, you need to raise around. But if you're going to have, let's say, 10 or 15 investors, think through and make sure that each of them can add value to you, because this is a 10 to 15-year journey that you're embarking on to build a company, and you're going to need a lot of help, right? So, finding active, let's say you're getting a group of angel investors in addition to, let's say, a venture fund or a seed fund. Make sure that those angels actually are ones that will, be able to add value to your business.
All right. Next question, Ashwani Sandeep. What are the common terms that founders can expect in term sheets that they should not agree to?
I think to some extent I tried explaining that when I was explaining the economic and commercial rights or governance rights, it's not about what rights should not be there, but in what form are they acceptable. So, say for example, liquidation preference, 1x non-participating, any founder should take it because that's the market trend. The moment you see a participating liquidation preference or a liquidation preference multiple, then yes, there are challenges. Same thing with anti-dilution. Full ratchet is a big no-no, and same thing may apply to as in milestone-based, case-to-case basis. You can agree to it if you have given the projections to the concerned investor. But otherwise, like broad-based weighted average is very well accepted in the market, very well received, and it is equity shareholder and founder friendly. So it's not about the right which should not be there, because most of the investors more or less will have the same I would say list of rights, but the form is definitely very, very important.
Sandeep, anything to add?
No, I think Ashwini's covered that. I think there is nothing that I think over a period of time, all legal firms have of investors have collaborated together and agreed on what are standard terms, right? So I don't think so. There is anything that you would say that's out of the ordinary. So no, I think no. Answer is no. Ashwini's covered it all.
And with that, we'll wrap with what is more of a comment than a question from a viewer who says, this feels so complex, the jargon is just killing. Either I'll have to hire an accountant right away or forget about getting into search. So Rajan, perhaps you would like to assure him it's doable.
Yeah, I think, look, firstly, keep in mind, all of you are seed stage founders, I'm assuming. You're going to be building a company for 10 to 15 years, and you're going to have to learn thousands, if not hundreds of thousands of new things, right? Learning what should be in a term sheet, a shareholder agreement, and what you should expect in diligence is going to be the least of what you're going to have to learn if you're going to build a legendary company. So let me start with that. If you think this is complicated, you know, I have to tell you, it's going to get a lot more complicated as you try to build your company, right? Let's say to build a legendary company takes 10, 15, 20 years and a lot of work. Now, that being said, look, the reason we're doing this is because we felt that the ecosystem more broadly, seed stage founders, can really benefit from learning about these things and sort of help almost decode, right, how you should look at a term sheet. This last question was very helpful. What are the things that you should really be worried about, right? If you have a liquidation preference of, let's say, 3x, that's not a good thing, right? 1x is okay, so you shouldn't debate that or argue with that. So that's what we're really trying to do. Now, that being said, look at Surge. We've tried to make it very simple. At the end of the day, right, what we're looking for is extraordinary founder market or founder product fit. We're looking for founders who we think are really passionate and have very deep insights and have the resilience and perseverance to build very large companies over a long period of time. Secondly, we're looking for markets that are large enough and have problems that are really acute enough where you can build a real company. And thirdly, if you've launched, we're going to look for customer love, right? We're going to look for indications of customer love. And if you're a post-revenue company, we want to make sure that the unit economics are beginning to make sense. You're never going to have perfect unit economics. And then we go to the next stage. I think what we've tried to help you understand here is when whether it's Surge or any other investor goes to the next stage, the things that you should expect, right? There, and by the way, the Surge term sheet is the simplest term sheet you're going to see, right? And for those of you that we are fortunate enough to partner with, because really it's an honor for us to partner with our Surge founders, find out that it is a super simple term sheet. The same thing with our shareholder agreements, right? But when we get into diligence, for instance, just be transparent, right? If you say, look, we've got 30-day retention of 22%, make sure it's 22% and not 7%, because 7%, that would be a big surprise. It would be a no, right? If you've got a little bit of revenue as a seed stage company, just say what the revenue is. And I think, as Sandeep said or Ashwini said, try to make sure it's reflected in your books. These are not hard things to do, by the way, right? Think about it. If you're going to build a very large business, you're going to eventually have extraordinarily deep financial systems. We're not saying go have a deep financial system. We're just going to say, if you said you had 50 lakhs of revenue, that should be reflected in your bank account. That should be reflected in your transacting statements, right? So that's sort of what we're saying, right? So it's not complicated, but do keep in mind that if you think this is complicated, you might just be a little surprised as to how complicated it's going to get to build a very large business. And by the way, that's really what we try to do at Surge, right? We work very closely with our seed stage founders to help them understand all the different aspects of what it takes to build an enduring company. So, but it's good feedback. But this is not meant to actually give you concern. It's actually help you meant to understand more about what you should expect in a term sheet, and also how you should prepare for due diligence. But as I said, our decision to invest or partner, I should say, with a search founder or founding team really has to do with founder market fit and the founder capabilities, the target market you're going after, and early metrics if you have them. And as I said, many of our companies that come into search actually are pre-launch companies, or they don't even have any metrics to speak of per se. So hopefully that's helpful.
Thank you, everyone. I think we are at the end of this. We've already overshot our time by 20 minutes. So just like to thank everyone for their time and attention, and we can wrap.
Terrific. And before I hand it over to Gautam, thank you again, Ashwini and Sandeep. That was very, very insightful. I've worked closely with Sandeep and Ashwini for some time now, and every time I listen to them, even I continue to learn from them. So thank you so much. I know it's we took you away on a Saturday afternoon to spend time with our founders in the ecosystem, and we greatly appreciate it. And before we wrap up, I know many of you have dialed in 4 weeks in a row, have been to part 1, part 2, part 3, and part 4. For those of you that have, thank you. I hope this has been very helpful to you. And for all of you that dialed in this week, thank you for joining us. We really do hope that you'll be able to take away at least a few, if not many, takeaways that will be helpful to you whenever you get to your funding round and get the term sheet and get into due diligence. And last thing is, look, for those of you that have not watched part 1, part 2, and part 3, please do go ahead and watch that, because we've got tremendous feedback from founders who actually came to part 1, 2, and 3 that it was very, very useful. So with that, thank you again to Gautam and the entire Startup India team for partnering with us at Surge. We are deeply grateful for this partnership, and we look forward to doing a lot more with Startup India and with all of you. With that, hand it over to Gautam. Thank you, everyone.
Thank you so much, Rajan, Ashwini, Sandeep, Payal, Alyssa, everyone who's been instrumental in putting the series together. This entire webinar series over the past 4 weeks has been an absolutely enlightening experience for me personally. It's not every day that one gets to learn directly from industry leaders like yourselves. I've picked up so much from these sessions, and I'm sure our audience has taken away quite a bit as well. While we'll sign off for now, we obviously look forward to a lot more of these wonderful sessions for our keen entrepreneurs. For our viewers, if you have more questions which couldn't be addressed today due to the paucity of time, you can reach out to us on the contact details you see scrolling at the bottom of the screen, both Search or us at Startup India. We'd love to hear from you. Have a great Saturday evening. Be safe. Bye. Thank you, everyone.
Thank you.
Thank you, everyone.
Thank you.